Hi, Steve Van Metre here, and welcome to your Monday Night Premiere. We take about 15 minutes every Monday and Wednesday night to try to make sense of markets. They really don't make a whole lot of sense. The good news is I'm finally starting to feel better, and the Fed is doing something that I predicted, I think about a year ago, somewhere in the last 12 or 18 months. And I said, when I wrote about this, and I wish I could refer back to it, I don't remember which update it was, that at some point the Fed would try to ease and end up driving interest rates down. And they're doing that right now. So if we look at what's going on, the Fed tightened monetary policy and the markets moved interest rates up. And that caused financial conditions to tighten and interest rates to come down. Now, to ease financial conditions, the Fed has lowered the federal funds rate 3 times, can't go any further without creating panic in the market. So they've decided to do a form of quantitative easing that really actually isn't quantitative easing. It's kind of weird. Maybe we'll get into this next week. But for the moment, they're buying $60 billion per month of U.S. Treasury securities. And in their meeting minutes from Friday, they said that this could be a big problem. And I want to show you exactly where that is, because I said the Fed would end up taking rates down. And I don't know if they're intending to do that. They're trying to put liquidity or dollars into the market. But here's what it means if you own bonds. First of all, this is the best news you could ask for, because you have the large commercial banks buying tens of billions of dollars a year. We can go look, $100 billion a year of bonds, but you have the Fed buying $60 billion per month. The Fed is the biggest buyer or potential buyer in the market, period. So how are most investors positioned? If we looked at institutional money managers, if we looked at pension funds, retail investors, how much of their portfolio is allocated to U.S. Treasuries? Not much, very, very little. So most people think, I don't need portfolio insurance because the Fed can prop asset prices up indefinitely. Right. And why haven't they ever done that before? Oh, well, they just figured out how. Yeah, I'm sure after hundreds of years of central banking, we finally figured out how to prop asset prices up for the very first time. So what's going to happen when you have large commercial banks needing to buy Treasury securities for collateral, the Fed buying up everything else, thinking that they're adding liquidity? When retail investors, institutional investors, pension funds decide they need portfolio insurance, and speculators who are betting on the opposite side realize that they're betting on the wrong side of the market and need to buy bonds, what's going to happen to the available inventory of bonds when all these people come to a store to buy? Well, it's going to be a lot smaller than it was. And when there's a lot less inventory and there's a big surge in buyers, what happens to bond price? I actually am beginning to think that my earlier prediction that interest rates, 10-year treasuries would go to zero, I believe they're going to go further negative. I think 30 years probably will go below zero now, just because the Fed is vacuuming up so many bonds early in the game. And now let me show you where this is coming from. So let's look at the minutes from the Federal Open Market Committee in December. Now, just if you've never seen this before, the Fed will release minutes after their meeting about a month later, and they use this as an opportunity to fix any problems, or if the markets didn't like something, they can change the language in the minutes and say, oh, but this is what we really talked about. Now, if you think that that is weird, it is actually true. So let's go and look. There's a specific part that I want to look for, and in this monetary policy section somewhere, open market operations. So let's go down here. And this, now they're talking about the person, excuse me, at the Fed who's in charge of running these overnight dollar loans, who's in charge of the term dollar loans, is in charge of buying up the $60 billion of Treasury bills per month. And so it says the manager discussed 2 operational considerations around policy implementation. The first involved the risk that future Treasury bill purchases could have a larger effect on liquidity in the Treasury bill market. What they're about to tell you is, we bought everything, or we're about to buy the whole market. In light of expected seasonal declines in bill issuance and the Federal Reserve's growing ownership share of outstanding bills, if this risk were to materialize, which means it probably is going to, the Federal Reserve could consider expanding the universe of securities purchased for reserve management to include coupon-bearing Treasury securities with a short time to maturity. Now, this is very, very, very important. What the Fed is telling you is, if you went to the Treasury securities store, they bought almost all of the bills. That's what they're telling you. Or said, hey, at the current rate, we're going to buy up all of these. Now, if you were a pension fund manager, an institutional money manager, or some mutual fund manager, and you wanted to go buy Treasury bills, what the Fed is telling you right now is, good luck, because we think we're going to get them all. So if you want them, what does that mean in terms of a portfolio construction? What is it going to do? It's going to push you down the curve. Now, what do I mean by that? I mean, someone that was buying bills, which are 12-month or shorter maturity, might go to 2-year treasuries. Someone who's used to buying 2 years might go to 3 years to 5, 5 to 7, 7 to 10, 10 to 30. And what's interesting, when you look at issuance, you see T-bills, the issuance of debt is huge. 30-year bonds is really small. So as you push people out the curve, they're going to buy more and more longer duration bonds and notes and cause interest rates to go down. Okay, I want you to understand that, because the Fed is effectively telling the markets right now, hey, we're pretty sure we're going to buy up all the bills, and when we're done, we're not going to quit. We're going to go to short maturity, or next level would be 2-year Treasury notes. Purchases of these short-dated securities would not affect broader financial conditions, right, and the stance of monetary policy. So they're saying, look, we said we're going to do it, we're going to do it. The manager also discussed expectations to gradually transition away from active repo operations next year. Now, remember, this is mid-December is when this was originally done, as Treasury bill purchases supply a larger base of reserves. So what they're saying is, hey, those overnight dollar loans, those term dollar loans, we're going to scale them back. The calendar of repo operations starting in mid-January, or next week, could reflect a gradual reduction of active repo operations. So what they're telling you is, hey, those increased limits of dollar liquidity loans, we're going to reduce them and push those. We want those dollars back now, and we're going to return those Treasury securities to whoever was borrowing the dollars. The manager indicated that some repos might be needed through April, when tax payments will sharply reduce reserve levels. So there you have it. The Fed is doing exactly what I predicted they would do. They would eventually come in, either through the federal funds rate or through active purchases, lower interest rates. And the problem is, we normally don't see, I mean, there's only a problem if you don't own bonds. If you own Treasury, this is the greatest news you could hear all day. The problem for all these other investors is when they decide they need portfolio insurance. Because again, you go, well, why wouldn't some, institutional money manager do it? Look, I'll give you a perfect reason why. Let's say you're managing a 60% stock, 40% bond portfolio. And in your bonds, you put half of that 20% or 10% of the total portfolio in Treasury securities. Odds are, over the last decade, that has caused you to underperform your peers. Now, in the world of money management, you're only good as long as people either like you or believe in you, or your returns are good. Pick one of the three. They think you're good, that your returns in the future are going to be really good to make up for whatever you've done in the past, or that you're on the top cusp, because it's pretty easy these days to go move money from one place to another. So if you're lagging and you're an institutional money manager looking for more assets, you're going to get rid of the laggards in your portfolio. So you're going to take those treasuries and you're going to trim them down, maybe to T-bills and maybe into other corporate bonds or something else that has a better return. And the problem is, when the markets go down, all these money managers will be chasing Treasury securities to hedge their downside risk. And what we are now finding out is, because the Fed has gotten to the party early, normally they don't do this quantitative easing thing until later. Okay, I want you to understand that. How does the Fed normally operate? They lower the federal funds rate, and then when that doesn't work, go out and buy up everything you can. But the problem is they said this was a mid-cycle adjustment, and the only mid-cycle adjustment was 3 cuts and done. And by now, we should see the U.S. economy rebounding. We should see the global economy rebounding. We're not. And so the Fed can't go cut the 4th time because they know the moment they cut the 4th time, the market is going to panic. So they're going out and buying up all these bills, T-bills, and starting to move into notes probably in the next couple months, leaving no supply left for everyone else that's going to want it. That's the great news is for those of us that have them, it means lots of people are going to want them. That means prices are going to go way up. So let's take a look at the charts. And I partially did intend this whole video to be on the bond market, in case you're wondering. I have some other stuff to look at, but I'm just not sure we're going to get there. Let's look at 30-year treasuries. And on that note, if you're wondering why we're not doing the hedge fund positioning, it's due to the last week's holiday week. That day has come out today, so we'll look at it Wednesday, and then next week we'll be back on track. So look at 30-year treasuries. Why did they rise today? Well, it's very, very obvious when I'm about to show you how to read this chart. So you see these 2 purple lines that are close together. This is a supply zone. And what this means is this is where either buyers or sellers have been. In this case, it's sellers of treasury securities have been here because when you sell, you cause interest rates to go up. So you can see selling here, selling here, selling here, selling here. So what's happening is yields are going sideways. And when you have the second largest and possibly now the largest short speculative position in Treasury futures, so it's either one of the two, it's really close to the largest or it's the largest now. And interest rates are going down because large commercial banks are buying and the Fed is buying. You've got to defend your position. You've got to get somebody to sell. I don't think there's anyone else left to sell. I think the large commercial banks and the Fed have bought up pretty much everything. I mean, we're not seeing foreign central banks really selling. They're pretty much holding. But when you look at this supply zone, which is support, so yields come into support, and we saw sellers here. It makes perfect sense. They gapped down there last night, and we saw sellers come in today, and we see Treasury yields sitting right below, 30-year yields right below their 50-day moving average. We see 10-year yields below their 50-day moving average, and we see 5-year yields below their 50-day moving average. And let's look at TLT, the most broadly traded Treasury ETF, and you see it held its 50-day moving average. It started the day higher, and through a process of just hammered, you see speculative selling all the way down, and then market rebound. Hey, no more sellers. And then no, they came back. We have to keep selling this thing down because they have such a deep speculative position that if this was ever to unwind, they would be chasing this bond market all the way up. So this is not a surprise they sold here. Now, I don't have 2 dashed purple lines to match the other one, but we can move it down right into here, and we can see selling, 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 selling all around this dotted purple line. So it makes perfect sense because as bond prices push up, it's going to flush out the people that were short here, then the bigger position of short here, and then eventually here, and then you get a tidal wave of bond prices just going straight up because you have so many people that are going to chase this bull market breakout. They're going to sell stocks. You're going to see portfolio managers chase it. You see asset allocators chase it. You're going to see everybody that didn't have treasuries is suddenly going to run for them. And so this makes perfect sense today. Now, what we'd like to see is it hold this 50-day moving average and continue to rise in the days to come and squeeze out these short sellers. The economic data certainly has not done anything to cause people to sell stocks and buy bonds. And if you're a bond owner, that's the greatest news, second greatest news you can ask for, because every day the market doesn't sell off is another day the Fed chews up some of this inventory. The more inventory the Fed's going to eat up, the more inventory the banks are going to pull in, all means the higher bond prices are going to go. So with that, we'll kind of wrap things up until Wednesday, where we will take a look and see how hedge fund managers are positioned. And my guess is they're even deeper in their Treasury short positions. The content of this video provides educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. I'm Steve Van Metre. Bye now.